podcast where we put you on the map. This is Ron Costa, broadcasting mobile today in the great state of New York. And folks, today we're going to talk about real estate and some winners and losers. We're going to take into account a whole bunch of different investments, and we got a great guest for that. And to get this thing going, let's introduce Vicky Hutchmala from the World Token Market. Vicky, how are you doing today?
I'm doing fabulous. You know, as I say every time, Ron, another fabulous day in Vegas, so what more could we want? But we have a really exciting guest today, and we're going to talk all about real estate and everything that has to do with it, so let's get started.
Yeah, and a repeat guest at that. And by the way, Vicky, where exactly. I'm in New York right now, it is raining, so and it's raining all day. It's going to rain tomorrow, and I'm kind of wishing I'd get back to Vegas soon. So with that said,
and we wish it would rain too.
Right. So let's introduce Ryan Garland. Ryan is the CEO of Paradyme Investments. You guys know him from the previous podcast. Ryan, how you doing today?
I'm absolutely fabulous, and thank you guys again for asking me to come on for the second round. I was looking forward to it all week, so thanks again.
Yeah, same here. It's always a good podcast when you're on, and you always give us some great information. And your company is doing, some amazing things. Like I told you offline, I subscribe to your blog, and you keep it updated with all this great information. So anyone who's listening to this, check the show notes. We'll have it all on there. You got to subscribe to that blog as well. But Ryan, let's get started with this. And for people who may not have listened to the previous podcast, tell us a little bit about yourself and how you kind of got into this whole real estate industry.
Yeah, and before I go too far into my background, because it's kind of a long story, how I met a very high net worth gentleman in Vegas, believe it or not, that provided a bunch of funds for us to use to start doing fix and flips. But so my background is really in civil engineering. I was actually going to school to be a civil engineer. This is prior to 2008 crash, and this was 2002 and 2003. I ended up meeting some friends that were in the mortgage business and really enjoyed the fact that they had a life. I didn't have a life. I was working full time and going to college. And he offered me to come over and work for him for a little bit and see how the traditional mortgage world worked. And I saw the type of money they were making, and I figured, hey, I could work part-time and go to school full-time and finish college. And learned really quickly that I could probably make more money doing traditional mortgage and financing than actually being an engineer. So I stayed in it and dropped out of college. And unfortunately, but fortunately, stayed in the business and had a really good run up to 2008. And then all this post-2008, I stayed in the private sector. And we actually still own a mortgage company now, but more on the private money side. So we do small balance commercial, fix and flip type transactions and loans. And then eventually just kept adding zeros behind our transactions and rubbed elbows with the right people, and now we're doing, hundreds of millions of dollars in financing.
Excellent.
Yeah, that's fantastic. I have a question for you, though, Ryan. How come the people that you meet in Vegas are venture capitalists with a lot of money, and the people I meet in Vegas are all gamblers and degenerates?
All right.
We should start hanging out with you, Ryan.
Yeah, let me tell you what I did, so you guys will love this. I'll make it as fast as I can. So when the crash happened in 2008, I told all my friends, I was single at the time. I said, hey guys, let's go to Vegas. Let's blow all my money. I had like $70,000 or $80,000 in savings. We'll come back. We'll live in the house that we're in right now because they're all living with me. And I said, we'll file bankruptcy and then become pizza delivery guys for like 5 years. And they said, perfect, let's do it. So we went to Vegas that Friday, actually, and I was spending a bunch of money buying everybody bottles, and the whole lounge was kicking off. And it was really kind of funny. At the end of the night, a gentleman came up to me. He was a really wealthy Asian guy, and he said, hey, so what are you doing? I mean, everybody else is, trying to survive, and you're over here blowing all your money. And I told him the story, and I was from the Inland Empire, and I did finance, and this was my entire company and the whole story, and he thought it was just the funniest thing. And come to find out, he was actually a hedge fund manager from China, and they had predicted this downfall for a long time. So he actually came out to Vegas knowing the foreclosure capital of the U.S. was going to be Vegas, and just trailing behind that was the Inland Empire. So as he invited me to go see a REO Mac or a Rio Mac, if you guys remember that back in the day, it was basically an auction where guys from IndyMac and New Century were all in this auction, and they were buying banks, all distressed assets. So I was exposed to this within about a week, and I started realizing, hey, man, where the money's at in the private market. And he ended up approaching me and saying, listen, go back to go back home and start providing, stated income loans again. And so trying to do that and ended up, kind of fast forward a little bit. We weren't able to do it. Everybody was, hurting for jobs, and it was just hard. So we ended up doing short sale leasebacks. So we ended up buying these properties that people wanted to stay in their homes and keep their families in their homes and kids in schools. We started buying these properties as a short sale and leasing them back to the homeowner, the original homeowner. And that became really popular. And we started making a lot of money there. And then, laws and things continued to change. And then we started looking at REOs, and then we started buying REOs. And I've facilitated and been involved in whether lending or involved in flipping for about 1,000 homes throughout California, some in Vegas, mostly Southern California. And then just stayed in the seat of being a lender, and then again adding zeros, and now we're here. So that's kind of the backstory. Yeah.
Yeah. So you've seen the whole real estate market from top to bottom, basically. Let me ask you a question. Let's get this thing going with this whole coronavirus. What are you seeing in terms of the effect on real estate, on coronavirus's effect on real estate?
So I think the two biggest assets, and this is no shock to anybody, that are going to be hit the hardest are any retail, commercial sector, restaurants, small strip malls, small businesses that are, leasing out of some of these things, some big anchor tenant, mixed use kind of development, infill development, stuff of that nature. But, there's that, and then you're going to see, I think office is really going to take a hit. At first, I think office was going to get hit the hardest just because of the stay-at-home order. And then I realized when you start trailing the data on how many companies started working from home pretty well, even from our own experience, I have an 8,000 square foot office, fully staffed, and I ended up letting a lot of people take their tools home with them, and we operated just as good with everybody out of the office as we did in the office. So, cutting your overhead and doing stuff like that, I think is going to be actually a next movement. It's not because they have to, it's because they want to. So I think office is going to take a really pretty decent dive, and retail is hard, real hard.
Yeah, if you have somebody, if you have an office, let's say you're an owner of an office building, what do you do in that point, though? I mean, do you just take the hit, or do you sell? Do you hang in there, or what?
Well, so I'm really big in generational trends, and one of the biggest things is like health and wellness, and what we're seeing kind of other big builders and developers do that their core focus is office, is they're really creating a very unique space for the tenants. What we're seeing too kind of come out is these spaces where it's like a WeWork, but you can actually bring your team in there, and you could rent it. Let's say you wanted a conference room for one day a month or whatever, so at least everybody can kind of at least come together. Like, we've discussed that as a team, and we found a place that was local, and come to find out some of the other people that we just kind of cross-pollinate with are all kind of looking at doing the same thing, and even creating that same space maybe in their office if it was big enough. So you're going to see a kind of a unique adjustment to office where people will definitely be working from home, but there is a very important collaboration component to a lot of businesses, especially in the tech sector, finance sector, so like for us. And so there's some of us that really need to stay in front of each other, and then there's some of us that don't need to be in front of each other at all. So you're going to see the space being kind of created where it's a upbeat, fun working space. You're going to have some health components to it, where there's there's a company called Delos that's providing hospital grade air and circadian rhythm lighting and stuff like that. So you're going to have more of that type of environment that's going to need to be created from office owners and building owners, my opinion.
Yeah, and how about retail? What do you do if you're a retail owner?
You know what? I'm going to tell you right now, it's going to be hard for me to talk on that because I just really don't know. I would like to. I wish I had like a direction, but with everything going on right now and how hard retail is being hit, and of course I'm in California, so I'm kind of looking at things from a little vantage point with our stay-at-home orders, just a completely different atmosphere. So right now I'll use this as a perfect example. The gym that I go to, almost every gym in the area has completely been shut down, clearly, but there's lawsuits pending against the cities now with certain cities. So it's not just being shut down. It's what's happening is people are fighting back, and now people are willing to sue. And so it's just all of those components when you add it up, it's almost hard to predict what's going to happen in the future. So I think ultimately you're going to see a 40%. This is what just most data. Now, again, I don't want to be the one leading leading this. This is just kind of collective data that we're trying to track. We're seeing about a 40% decrease in retail space and office space on average. So if you got a building that's worth, $1 million, you're going to basically be able to pick it up for $600,000, and the value is going to end up dropping to, $600,000 or so. I'm using that as just one example. So those are, I think, how hard those asset classes are going to be hit. And a lot of people, I'm listening to pension funds and other big funds that are opening up distressed asset funds, getting ready to buy these assets, but they haven't pulled the trigger yet because we still haven't hit the bottom, and they really don't know where it's at. So retail space, I don't know, man. Some spots I think you can go vertical, maybe do some apartments above it and retail on the bottom down the road, something that's usable for the density, But all that space is going to be adjusted too. We just hard to know exactly how.
Well, and a lot of the larger retail like Macy's and that they're leaving the mall atmosphere and going into smaller local stores because of the hit from the virus. So that's going to leave all of the shopping centers and all of the major stores, department stores, empty, and so somebody like yourself with a vision can go in and redevelop those into multifamilies.
Yeah, in every area, every city is going to be different. I'm using that again as one example. Some areas you can't go vertical or go above it. So everything's going to be different.
Right.
But, I agree with you 100%. Like those big department stores, but if you look at Amazon, I use everything to try to be relative from examples. I went into Target and some other, areas looking for stuff for my kids the other day, and there's nothing on the shelves. Even a razor, I couldn't find a regular face razor. And I ended up getting in my car, and I sat on Amazon and ordered everything on Amazon. It was going to take a couple of days, but who cares? It's a couple of days. Now we're not even going to these places. So I think from not even just a department store, I'm thinking on almost every level. I'm watching some industrial places out. There's a lot of opportunity zone out here by us. Kind of scattered throughout SoCal. It's very dense, as 22 million people, and throw a rock in any 4-hour drive. It's a lot of people here, but there's a lot of big industrial buildings that are in the opportunity zones. And what they're doing is they're leasing smaller spaces for these smaller up and coming businesses that are doing a lot of e-commerce and stuff online, buying their product online, and so you're seeing this huge uptick of people obviously buying online, clearly, right? But even from banking to investing to everything is being done virtual now and digitally. That I think a lot of that stuff that's going to play a major effect. So and how easy it is now to return stuff through Amazon,
And it's the one thing that the virus did is it kind of paused the world and gave us a new perspective. And so now, because of that, everything is changing. What we used to do as automatic is now completely different and becoming the standard automatic thing that we do, like online purchasing and not going to the store and working from home or in just changing. Everything has changed in the business world and in our private lives. I think that's one good thing of the virus.
Yeah, you nailed it.
Exactly.
And to add and compile, I have 3 young kids. I got 2 12-year-olds and a 4-year-old. And my 12-year-olds, I have one girl and a boy at 12. And my daughter, she loves her friends. She wants to be with her friends. She plays 2 sports. That's shut down. My son plays year-round sports. That's all shut down. So to see them not go to school and see the impact on them, it's changing absolutely everything.
Yes.
And so I don't want to go into the political stuff because it really doesn't matter. The bottom line is how it's going to affect us. And ultimately we just try to navigate the waters to make sure that we're making right decisions for our investors and for our future. But, the reality is that things are changing so rapidly, it's almost hard to understand which direction to go. So what we've done is just kind of streamlined it and said, okay, we know this one thing and we know this one thing very well. But we also know the need of housing. We also know the need of affordability. We also understand, the shortage. That data is kind of not rocket science, right? So what we've done throughout this whole coronavirus is we were very diverse. We were very much like a CrowdStreet kind of platform, but we're structured a little differently. We're a much smaller family office. We're very hands-on on the development. We don't just kind of introduce the investors to the sponsor and to the transaction. We're actually kind of another third-party underwriting company, if you will, that's also putting skin in the game. So there's a different attribute on the underwriting that bring a different component to the underwriting, how we look at it. But at the same time, what we did is we said, look, one of our best projects right now, which is a 45-unit townhome project just outside Denver, in a little secondary called Lakewood, and that it's doing great. Anything in single-family affordability, is great. It's a new product. It's got new building material. It's got all the technology. It's got solar. It's got rooftop decks, and so those things are just flying off the market, right? So we know, that space very well. So we've just ultimately what this has done for us is streamlined in the one marketplace we know and we know well. And that's what we feel is going to be the smartest asset class, at least for us, to stay involved in.
Well, even people's personal living spaces have changed because of the virus. Now, everything about your home has changed to accommodate everything outside of your home and what's going on. So, the standard house that you used to go and live in is going to be different now because now you need a major space to do your work from your house and to accommodate everything that you order online. Yeah.
I love talking to you guys because you guys are on it. So another perfect example is my wife and I, when this coronavirus hit, we were like, okay, I don't have enough space really for a good office. Mind you, I have 3 young kids. I kind of need my own wing to get away from them, right? I'm going to be working from home, right? That's really the bottom line.
Yeah.
So I'm buying them trampolines and all kinds of toys. Like, you guys stay away from me. I'm going to go work. But we did. My wife and I found another property. We moved into another property. It's a little bit bigger, but it has a nicer office. And I know just through, my own experience, being comfortable and working is really important. So we looked and found something and said, hey, we know people are going to start dumping houses because they're worried. And we went through 2008, so we were positioned a little differently. So we grabbed something, and then, we said, look, this is going to be the best way. So you nailed it. It's even in your own personal workspace life, you have to start making adjustments. And I think what the scary part is that it's happening so fast and it's happening overnight, and it's really, again, hard to predict or even know how to feel about it. And then with all the political stuff going on, it's just a really very scary and unique time for everybody. So that's why we go, okay.
And everything is new. Everything is new.
It's
like you have to recreate the wheel in order to live into the future because the past isn't going to work anymore.
Yeah, and what data do we have to pull from, right? So, think about it from our perspective. We're always looking at appraisals and we're looking at past data. But with all this other stuff, what do we have for data? We've never had a pandemic before, a worldwide problem like this before at all. So there's nothing really for us to pull from, and you really don't know how to go about it, and you also don't know what to believe whatever you're reading anymore, right? So
that's exactly correct.
So us personally, what we did is I looked at my family and said, the bottom line's family first. And I couldn't tell you, it's been bittersweet. I've actually been spending a lot more time with my kids and my family, which has kind of made me humbled and said, that's really where I want to be. So I kind of looked at it and said, okay, team, less is more. My entire team feels the same way. We're all kind of in the same boat. And we said, look, let's stay less is more. What do we know? Again, going back to what I was saying before, what do we know? What do we know really well? And so we have a mortgage division. We have our real estate division, which is really easy. That's what I call my boots on the ground data. For example, one of our properties out here, one of our listings that we had sold for $40,000 over asking price because there was just no inventory. But where are you going to get that? You can't really, you can't. So the only way to understand what's going on in the marketplace is by dealing with the consumer. And so having those boots on the ground has been really fruitful for the private equity side or the private placement side. And then, it also allows us to have more irons in the fire and to put food on the table, right? To keep the lights on. Right. So we have, real estate commissions coming in. We have mortgage stuff coming in. So we've been diverse in that fact. But we know that space, and so we're comfortable. So we're just going to ride this out. We don't know how to really look at it, but we're going to do the best we can, and we're going to stay proactive, and we're not going to put our head in the sand.
Well, and the most successful person and the most successful business are going to be those persons that have the greatest ability to adapt, to relatively see what's coming because of what happened, and adapt what you're doing to meet it and show everybody else how to do it. That's the secret right there.
Yeah, I think you're quoting Charles Darwin now. Yeah, you nailed it. Right. Yeah, you nailed it. I mean, that's probably one of the biggest.
Oh, is that what you call survival of the fittest? I feel like you and I are
family. Yeah, I mean, there's a reason why I named the company Paradyme. You really have to shift, and you have to be comfortable getting out of your comfort zone. If you think about it, just the way we're designed, we love all of us. We all go to bed the same. We all sleep on the same side of the bed. We all have We're a product of being consistent. But when it comes to this business and this time, you have to learn to get comfortable outside your comfort zone. And then you also have to, no matter what, realize that you are taking a risk. But you have to, look at it instead of an emotional standpoint, try to look at it from a business standpoint. See, does it make sense? Cross-check, and just make that move. And that's actually been probably several conversations I've had the last couple of days with other business owners. We've all been very collaborative, going, hey, look, play the course, man. I mean, you're always gonna be okay, but stay in that course, do what you know, but take the risk, enjoy the time with your family, and just whatever happens, happens. It's kind of how you have to look at it.
That's
that's true.
And deal with it.
Yeah. And deal with it. Yeah, and deal with it. But I think the biggest thing and the most important, I think one of the things that I'm going to lean on absolutely the most, it's again bittersweet. Since everybody has been home, everyone's been doing Zoom meetings, right? So the amount of exposure we've been having and the speed in which our business has picked up in certain components and certain aspects has been insane, because we are able to have these conversations with people. It's everyone, I think, at least I've been coming across, like this conversation now, has been very humbled. So we all get a chance to really be humbled and talk about our past, our history, what we've been through, and say, okay, how can we stick together? Here's what we do best. So our alliances have really built, and it's been really pretty impressive.
And plus with the Zoom meetings too, Ryan, you get to see people's pets. Right?
Or kids.
Pets. That's true. Pets, kids, yeah, exactly. Get to really know each other,
But getting back to something that you were talking about before, you've been a winner in the single-family homes. What do you guys think about the multifamily asset class? Is that a winner as well? And if so, Absolutely. Is there a difference between A, B, or C properties?
Yeah, so I don't trail a lot of stuff that's in the B and C class. I'm more A class and more kind of primary markets. But ultimately, multifamily is absolutely great. I mean, right now, if you just look at all the data and how much, people are still collecting rents, there's a couple clubs that I'm a part of. One's an international one, believe it or not. There's about 4,000 members. There's 300 people on the board, and I'm one of those 300 as a specialist. Geez. And a lot of the guys that all listen to the multifamily specialists all the time, and these guys are talking about, they're still collecting rents on 92% of their portfolio. They've been working, diligently to, work with the tenant and, charge late fees or maybe half rent up front, half rent in the, in the middle of the month, stuff like that. They've been really good. So, I'm seeing stuff anywhere between, worst case, I think I've heard 78% to 92%. And, at 78%, you're still debt servicing mostly, right? If you look at it from a financing, traditional financing and underwriting kind of DSCR components and lease-up component. But the reality is I think the multifamily is great. I still am swinging for that fence too. So we're definitely involved in multifamily as well. Anything that has to do with housing, I think is going to be just fine.
Well, how about?
Well, and I think it goes back. I was just going to say, excuse me, Ron, I was just going to say it goes back to what you were saying with multifamily, you have that sense of humility too. Everybody's in the same boat, and just because you want people to pay their rent on time, but they're in a difficulty, you have to give and take and adapt so you keep your renter, but at the same time allow them to be able to pay the rent as best they can. Goes back to humility and getting along and adapting.
Yeah, and I think, a lot of these operators, they've been in business a long time. They've had their ups and downs, right? And I think ultimately, when you get to a certain point in your career, you just want things to be okay, and ultimately you want everybody else to be okay. And the operators that do the best are always the ones that put their tenants first, their needs first, their whatever the service that they provide. And so I think by naturally, the operators that are going to be doing pretty well are really looking at it from that perspective and making it work. And honestly, that's what's needed right now is that humility. You nailed it. And I think, the transparency is huge. And just know, it's not like they chose this. No one's choosing to be broke. I mean, no one's choosing.
Yeah.
Right. So, so it's really important just to try to make it work across every level. And it's been great to see a lot of these operators how they've been doing it. It's been rewarding.
It's symbiotic too, because you work together so you can help the person that the renter in the multifamily, you help them, and then they turn around and do everything that they can to pay the rent and help you. And so you're working together symbiotically, and it works out in the end. And 6 months from now, you're going to have that same renter who's going to bring all his friends to you because you treated him right.
Absolutely. Yep, you nailed it. And or stay longer.
Exactly.
And the other thing too is a lot of some of these guys are pretty smart. They're thinking there's going to be more of an L-shaped recovery. So that really does mean that, again, I say it respectfully, the working class folk, they're not going to have really the opportunity to grow. There's going to be different, tech companies and stuff will start shining real well, but ultimately the typical working folk aren't in that tech space, so or a space that's growing that quickly. And so what I'm saying is that it's not like they're going to just all of a sudden get a boost of money and go move into a more upgraded apartment, right? They're going to have this kind of recovery time frame, and having your tenants happy is really important at this point because they're probably going to stick with you for some time. But here's the thing too: what's going to save the operator money is the fact that tenants not moving out. You're not going to have an empty unit.
Exactly.
You're not going to have to replace carpet and everything that you typically do. Now you'll do it here and there. But, you're going to get a little bit more wear and tear out of that space before you have to do a full remodel before somebody else moves in it. So, ultimately that's where you're going to save money too as an operator is keeping those tenants in there. So it's really important.
That's right.
Yeah, that's true. Let's get to just a couple more asset classes. You see anything going on in raw land, maybe builders doing assemblages and things like that?
Yeah, builders aren't stopping, man. I mean, anything that has to do with like kind of track stuff, anything luxury, it's not doing too well. But land is being picked up like crazy right now, especially the guys that have a lot of dry powder. They're going out and picking up land. They're looking at stuff 10 years down the road. Well, they'll maybe have some freeway that's going to be running through here sometime down the road, and they'll be selling that land for a lot more per acre. We're seeing guys do stuff like that just to bury their money. 1031 exchange, we're seeing a lot of opportunity zone investments, stuff of that nature. But land and development's doing really well. The only thing that we're having an issue with is really this bridge. If you have a builder or a developer it doesn't have a lot of dry powder, the one component that we're seeing that's kind of bottlenecking is this bridge financing between entitlement plans being approved to getting your horizontals and infrastructure in, all the way down to getting it to a point where you can go vertical, and now you get construction vertical financing. That bridge in between for horizontal work has really been it's been a little bit more of a problem, and the reason is because a bridge loan is really a short-term loan. And so that bridge lender is really saying, okay, we're banking on the fact that you're going to get construction financing to take us out. So the bridge lenders are really having a hard time, deploying capital. So that will, at some point, play effect on from the land going through development to actually going vertical. You'll probably see that kind of slow down a little bit. But land acquisition is still working, and I think that's still a good play.
Are people in the real estate business using Regulation A plus crowdfunding as a source of getting money?
Yeah, but Reg A is really more for startups, or I guess yes and no, and I'll tell you why I'm saying it that way. If you're a builder or a developer, you're not a capital guy, right? You may have been able to raise some money with some friends and family, and you've done okay, but to have like a whole platform, the back office that's really needed for a Reg A, it costs a lot of money. I mean,
true.
We've spent millions of dollars in our infrastructure, so it's just you get to a point where it wouldn't make sense for that builder or developer to use a Reg A to start raising capital. You actually have to have a pretty decent size development to want to go down that road. But you also need to start thinking outside the box on how you're going to market for all of those investors. Solicit for non-accredited investors. So, what we've learned for us to operate is, I have a pretty decent sized staff, and we're about as lean as we can get. And, we have a Reg A, right? But we do crowdfunding from a 506c accredited investors component too. But the amount of work that's involved, you really do need a team. So we are seeing it if you have a team. If you don't have a team, we're not seeing it as often. We hear a lot of talk about it, but once they kind of understand how much work is really involved in it, they kind of go, never mind, it's not for me. I'll just work with you.
And it's very expensive. It's very expensive.
Yeah, it definitely can be. And there's a lot of components. You got to have the right securities attorney that plays a huge part of it. And that's not cheap either. And you have to have the right CPA and the right investor relations software, and all that stuff adds up. The right CRM, and all of those things really, really does add up.
And you need a lot of marketing.
A lot of marketing, yeah, absolutely.
A lot of marketing.
Everybody's marketing for investors right now. So you have to, and then you have to have a sales team. Someone that's really fielding those leads, and leads are one of those things where you have to get in front of them as soon as they come in. So you need someone really specifically driven for leads, So there's a lot of moving pieces to it. And a lot of these, just so you know, a lot of these investors have IRAs or 401ks, a lot of 401k rollovers right now. And, going into an IRA. And so now you're talking about processing paperwork, and right. So now you're talking, so there's a lot of, each step just to start creating a crowdfunding kind of platform. It's a lot of work.
It is a lot of work. Yeah, it really is.
So let me ask you, what do you think about opportunity zones? Do you have an opportunity fund?
No, we do not have a QOZ fund. In fact, we were looking at a couple of projects that were in a QOZ, and we figured we would open up an SPV per transaction instead of opening up one big fund and going into it. And only just the simple reason is we don't have a big background in it. So I didn't want to go open up this big fund and take in all these deals and just be bogged down and something slip between the cracks. We thought it'd be smarter to kind of do one off at a time. And so we have a couple projects that we're tracking and going through underwriting right now for QOZ. But to answer your question, absolutely love QOZ. I mean, I think it's huge and it's absolutely needed. I think that was a really good play that Trump did on pulling out the QOZ, aspect, if you will. And so that's shining really well. But what they say is, a QOZ it makes a good deal a great deal, and it makes a great deal a home run, right? So you're getting these little step ups. It's not like you still have to have all the other components in place. You got to have the right builders, the right location. Everything else has to be right. It's just, the opportunity for people to invest money into these, commercial projects where you're getting the benefit of commercial returns and the real estate investment returns without having to do any heavy lifting. I think it's huge. I think it's a really, really great opportunity for people to get involved in.
Well, and for the same as with Reg A, you need to have the right attorney, the right CPA. You have to do a lot of due diligence to make sure you're picking the right zone. Just because you live in Vegas doesn't mean you should invest in Vegas. There's a lot of background, plus you've got to follow the criteria for the rules and regulations from the governmental rules to make sure you actually get the deferment of your taxes. All of that, it's complicated, but if you've got the right people, the right team working with you, it's a major score.
So you basically just nailed it. It in itself is its own business, from how the money's being moved, where the money's coming from, the processing of the capital, getting in front of the right investors, targeting the right investors, attorneys, audits, compliance, all that stuff. So if, that's why I tell everybody, okay, you're working with a company, do they specialize in QOZ? Because it really is one of those kind of scenarios. You really have to have either a company that's been doing it and has a big firm and knows what they're doing, or someone who's really just core focused on it and really has the team to support it and knows the steps to take. So there's a lot of moving pieces to that. Anything that has to do with the SEC and raising money, it's really important to make sure you have all your ducks lined up for sure. And having the right attorney.
Right, and then when you throw the IRS into it, it becomes pretty scary.
Yeah, that's a whole other component to it. If an investor invests with us from an accredited side, no matter where the capital is coming from, we kind of just 1099 them and they deal with it, right? When it comes to this stuff, there's another aspect that typically you want to provide as a service to your investor. And that brings in a whole other level of compliance. And you typically need to bring in a separate firm and partner up with a firm for that. So I've heard of, QOZ Opportunity Zone sponsors that are out there buying up CPAs and other, partnering with tax attorneys and stuff like that to really be able to do this and do it properly. But when I say, they're out there, absolutely, there's a lot of great professionals out there. They know what they're doing. I will way over talk me on it. But, what I tell everybody is just find the right people, the right company, the right firm, and they'll know exactly what they're doing. But again, they have to be a hybrid, right? They really need to know what they're doing on the development side, and they need to know how to raise money. So typically, you're going to find a nice little team support behind whatever company you're getting involved in.
Yeah, and Ryan, even though that you guys don't have a fund at this point, you do have another fund that you just launched, didn't you? Some kind of real estate related fund?
Yeah, we have two of them. One we're actually launching. Well, we're launching one literally as we speak. We're trying to do it this week, but it's $100 million. It's a small one, $100 million debt fund. It's what we call an income fund, really, because the single family space is still booming. What we did is we said, hey, listen, I have so many investors. I'm going to kind of make you guys smile. So every 10 years, right, through every downturn, there's a new set of investors that come out and play. Okay. So in 2008, all the guys that came out and started flipping properties and kind of did boots on the ground and started doing all the heavy lifting and legwork to buy, deal with the construction, deal with the sale of it, right, and actually manage the flip, those guys during a recession end up becoming lenders. They're like, I'm so tired of dealing with all the heavy lifting.
That's true.
Some other new guys are coming out of some, weekend seminar that know how to flip properties now, right? So that's what happens. So these guys kind of go into sitting in the chair of becoming lenders and still getting, for the most part, the same returns but no work. But at the same time, some of these guys, some of them are, real estate brokers. They have, another business also that's operating, an escrow company. Name it. A lot of them own other companies that are generating good, income. So that's what they do for their full-time job. So I tell everybody, hey, listen, if you are a past flipper, think about getting involved into this fund. And with my friends and family that we've approached for this, we haven't even gone out to market, but our friends and family, they know my history and track record in the business. So when it comes to vetting, fund control, watching over the project, vetting the contractor, doing site visits and all that fun stuff, we'll actually provide kind of a soup to nuts platform. We're going to be very under leveraged, very low loan to values that we're going to be providing on these properties, but it's all going to be workout turnarounds, fix and flip, single family, and small balance commercial repurposing and getting back on the market and selling them, or refinancing them. But that's what that fund is for. And then we have a GP offering where it's actually going to be a $300 million fund. I have much larger individuals and players that are involved in this. I have a whole team that's all kind of coming together for this, and we're going to actually buy and operate some of these distressed assets as well. We're looking heavily in Orange County, California.
Yeah, and can people get involved in this by going to your website and seeing all the projects that you have on there?
The debt fund or the distressed fund will not be on the site. That's going to be kind of our private offerings that we'll be talking to some of our net worth or our high net worth or existing clientele. I will be opening this up for other investors at some point. I probably will do it next month. So there'll be something where you can get involved. You can reach out, look at us, and we'll just say, hey, we have these other offerings. If you want more detail, let us know, because there's some trade secrets in those offerings that we want to keep kind of tight to the hip, right? So when someone calls us, we'll say, hey, here's really our business model. If it's something that you see a value, let us know. We'll love to bring you on as an investor.
Right. So some of these guys, they'll come to the website, they'll see some of the projects in the asset class that are winners that we already spoke about before, and then these are projects that you guys are running yourself, right? You're not really a portal. These are projects that Paradyme is doing. Is that right?
You nailed it. Yeah. So we're not a marketing company where we're just marketing to investors and then marrying the investor directly to the sponsor or builder developer. We're actually kind of the middleman. We're really what we consider, and it's really kind of cheesy, and it's just as simple as this. We're really a pass-through. But what we're doing is we're actually co-investing as well. So what happens is we have investors that are coming in and saying, hey, we like this deal. Someone that may just look at our site or see this podcast or webinar and say, hey, you know what, I want to contact them. So if they look at what we do, they can invest into one of these projects or a portfolio of projects. All that's on the site. You just kind of navigate through it, and you can read up on how we operate. And then we also invest our own money too. So we do a co-investment. So what happens is we're going, okay, we're going to look at it, we're going to underwrite it, we're going to deal with all the contracts, we're going to deal with the legality of everything. Because and I'm sure you guys know this, anytime you look at any type of ground-up construction or big value-add project, I don't care which way you look at it, it's just a lot of work, right? It really, really is. So for the smaller investors who want to get involved and, again, benefit from that commercial real estate investment returns, what we did is we said, look, we really understand what it's going to take to vet these deals and vet them properly and all the contracts that need to be in place and all the ducks that need to align and all that stuff. So we'll pressure test the deal. And then if we feel comfortable, we'll make an agreement on how much we're willing to invest. And because we're willing to put skin in the game, we'll then open it to our existing network and some other investors to get involved. And because we're also invested, they're going to feel more comfortable to get involved too. So now we're really the joint venture partner for every one of these transactions that you see. So when you say, yes, are we actually running them yourself? Yes, we are a partner, but we're really a partner from the financial support. When we have a big builder or a big name developer, like as an example, Dan Stevenson with Rancon, he's got a $185 million winery. But the guy, we call him the Godfather in Southwest Riverside. He's developed over, $3 or $4 billion in projects. He's been around since the 70s. So the guy, has never filed bankruptcy, has, every one of his projects has turned out. So he's got a very good and long, clean track record. Well, those are the people that we partner with. So when people look at us, it's okay, you can look at us to want to invest with us, but look at also the project and the sponsors that you're investing into. We're just kind of another set of eyes and another set of compliance and, and all those other little kind of collaborative things that need to be met to have a transaction turn out properly and for everyone to make money. So we really are a joint venture partner. So people come to us to raise the equity. So we're that equity firm. And so we'll raise the debt and equity in some cases, some of the debt, and we'll finance the project. So that's how we were set up.
Yeah, as an investor, that's kind of cool to know that. It's nice to know that you're not going in there where someone else wouldn't put their money up first. And that's a big plus, I think.
Yeah, and it makes sense for guys that want to get involved and I don't have maybe an existing relationship with or have a track record with, right? The other thing, too, just to kind of continue to add, we have the president of my company now, he's a former mayor. He's got connections all the way up to Capitol Hill, all the way up to Sacramento, and he ran the local EDC and all that stuff locally here. And so when you do it as a developer, and I say this and it's so funny, but a developer will drive by a project and go, oh, I could build all this right here, and that's their vision, right? But does that vision meet the city's needs and their vision?
Exactly.
And that's usually what we've really realized where there's a lot of clashing. So when you're looking at a ground-up construction project, depending on where it's at in entitlements and plans approved and so on and so forth, you want to make sure that that developer has not burned their relationships inside the city, right? Because that can create a lot of headache for us through development. And so we kind of go in there and start establishing those relationships with that private-public partnership and make sure that we're fitting their needs and we're getting the cities and local authorities support. So from a political standpoint, all the way down to, looking at each line item on the construction budget and pressure testing and value engineering the budget to try to shave costs and make sure we're going to hit our mark throughout the entire process. We're involved in it from soup to nuts. And so it's really kind of cool too, because our investors, one of the things is, and I think I was sharing with you guys on the last podcast, is a lot of our projects, as long as the project will fit, we actually have a camera where people can log on from as simple as an app on their phone, and they can look at the projects that they've invested into, and they can see live. They can see, live streaming right then and there on how the project is turning up. You can see workers there. You can see cranes there. You can see, them pumping concrete. You can see how these projects are going. So from a transparency side, we've utilized that technology too to try to provide that to our investors, saying, hey, look, yeah, even though you're investing over here, but you live in, London, hey, you could still watch over your project. So
that's fantastic. That's fantastic.
Yeah, we've done a lot of cool things like that. Yeah. Mm-hmm.
Yeah, exactly. Vicky, how about this information? Is this incredible or what?
Yeah, but you know what? There's one more thing I want to know, Ron. Ryan, when are you going to start tokenizing your projects?
Oh,
I've had a lot of people bring that. It's been catching my attention lately. I'm gonna start opening my mind to that. I haven't, again, really, because it's not my world. I've kind of stayed out of it, but I'm gonna open my eyes to that a little bit more and get to know it. But I've had so many people ask me about that, and I think that's going to be a new wave of the future. For me to be so heavy in technology, I need to stay up on that too.
Yeah.
Well,
exactly.
Ryan, Ron and I can show you the light.
Oh, I'd love to. Yeah.
We know all about tokenizing investments.
Yeah.
And
we'll I am so happy to jump on another call with you guys, and spend the time educating me. I'd love 2 ears and 1 mouth. I'd love to listen.
Yeah. And one more thing, Ryan. I don't think that we told everyone the website yet. How do people get in touch with you?
So you can go to my website, which is Paradyme Investments, but we spell Paradyme a little differently. It's Paradyme investments.com. So again, it's Paradyme investments.com. That's the best way. You can contact me. You can contact anybody in my team on there. You can actually log in and take a look at what the portal looks like and what the platform looks like on the back end. Just know that once you put your information in, then either a gentleman by the name of John or Harold are going to call you. So just to keep that in mind.
Yeah.
But you can at least kind of get the overview of how we operate and what kind of transparency we provide and service we provide.
Well, you've been so busy and you have so much stuff going on right now, and you took the time out to be on the podcast with us and speak to our audience. I really appreciate your time, and as usual, did a great job. Thanks so much for being on the show today. Really appreciate it.
Yeah, no, thank you guys for your time.
And I'll just make my last 2 cents and say, when I first met you, Ryan, I thought you were absolutely impressive person. But now, after 2 podcasts and talking to you, even in just a year's time, your impressiveness is just so apparent. Your vision and your passion and that absolute humility aspect, this just makes you an impressive person, a person with integrity, and somebody that absolutely everyone who's listening to this podcast needs to contact you because you're the right person to invest with. Absolutely.
Well, thank you very much. Yeah, even if people aren't too comfortable maybe reaching out to me or maybe not be ready, get on our email list. Like you were saying, Ron, you're watching some of our blogs, and we're actually providing some data right now that is not coming from a biased, vantage point. And we're just kind of, providing data to a lot of our investors and our friends and family and, people on Facebook and all the social media stuff. So, we're that's always some good information for people just to kind of keep up on because we're trying to look at things from, multiple vantage points and kind of come to a conclusion.
Yeah, I think you should take what Vicky just said and make it your LinkedIn profile.
I love it. Absolutely. If they'll let me type enough in there.
Yeah. Okay. Well, let's close this thing out there. We're going a little bit over time here. But again, thank you very much, Ryan, for being a guest on the show. Thank you, Vicky, for co-hosting, and everyone out there. You're listening to the Mappable USA podcast at mappableusa.com. If you go to that website, you can scroll down. You'll see all our syndication sources. You pick the one that you like best, and you'll never miss another one of our episodes. If you want to be a guest on the show, like Ryan was today, there's a guest tab. Fill that out. We'll see what you can do about getting on the show. And if you like what you heard, send us an email. We're at info@mappableusa.com, or just leave a comment where you're listening to this podcast right now. So everyone, thanks so much for your support. Thanks for listening, and we'll be at you next week with another Mappable USA podcast. Have a great week, everyone.